Hello and welcome to our latest fund manager interview. With me today is Walter Price, fund manager of the Allianz Technology Trust. Walter, thanks for your time today.
Great to be with you, Kyle.
The year 2020 was a very strong year of performance for the Allianz Technology Trust. Also, over longer time periods, the numbers make very pleasant reading for shareholders. Do you believe such high levels of returns are sustainable in the coming years?
A 70% increase in your portfolio doesn't happen very often, and I don't think people should expect that. We shoot for, over time, we shoot for 15 to 20% on a sustainable basis, and I think that, we've been able to achieve that, and I think that that's what we're shooting for in the future. Hopefully we can achieve that over the next 5 years like we have the last 5 years.
And after such a strong run for some of the more famous technology giants over the past couple of years, for those skeptics who believe tech is in a bubble, what would you say to that?
If you look at valuations of tech companies, there's some tech companies or some sectors of tech, like the manufacturing side or the semiconductor side, that are, in our view, they're significantly undervalued relative to the market. The number of companies that could compete has been reduced, the capital intensity has increased, and therefore there's a secular improvement in margins going on in that industry that hasn't been recognized by the market in terms of valuations. However, in the high growth companies, valuations are very high, and I think that that's because the measure that people use of PE or market cap to revenues understates the long duration of the growth rate of these companies. So, it's been very unusual for a company to grow at more than 50% a year for more than a few years. But I think in the case of some of these technology companies, as I mentioned, cloud computing, you're 10% of the way through a $1.3 trillion market moving to 50% in the cloud. And so you have hundreds of billions of dollars that's available in revenue for these companies that successfully execute that opportunity. And so, I think the duration of growth of many of the high growth companies, high growth tech companies can continue, far longer than a year or two, which is the usual pattern. And therefore, if you go out 2 or 3 years that we do in our valuation analysis and you look at the free cash flow generated by these companies, they actually look quite reasonably valued on those future progressions.
Would Tesla fit into that at all as well? Obviously, it had a very strong 2020 with the share price up over 700%, and it's held currently in your top 10. What's your view on the stock and also its valuation?
Well, the stock's in our top 10 because of exactly what you pointed out, as the appreciation was far greater than the rest of the portfolio. I mean, we've been trimming some Tesla, but the outlook for electric vehicles and for Tesla in particular is very strong for the next couple of years. We estimate that they're going to double production in 2021 and come close to another 50% increase in production in 2022. They have 2 popular models, the Model 3 and the Model Y, which are selling very well and are sold out in China, for example. So in many of these markets, they're becoming kind of the default EV car for people to buy because it's been out for a while, the bugs have been worked out through it, people know what to expect, and it's very good values. So, I saw a review of a car from General Motors, for example, and the reviewer said, well, this is a nice car, but it's overpriced by $15,000 or $20,000 relative to a Tesla. So, I think that they're going to be a tough company to beat for these other contenders in the EV market.
So the trimming is just a case of taking some profits after a strong run.
Right, and I think that competition will be a factor, not in 21, maybe not even in 22, but as we go out longer term, competition will be a factor. EV is an attractive sector. You have 100 different auto manufacturers. Some of them will get it right and produce a good value EV and be a a competitor to Tesla. So I think it's going to take longer than most of these auto companies think to mount a credible competitive effort against Tesla. And Tesla's not standing still; they're pushing really hard. But I think that they're not going to run away with the market. There's going to be competition eventually.
And of the famous FANG stocks, it's Alphabet, the parent company of Google, which is most favoured currently, followed by Amazon. Why is it that you favour those two companies over the other three?
Well, I think in the case of Amazon, the pandemic allowed them to bring forward their need to build out a distribution system to deliver to their customers. And once you have this distribution system in place, it's a tremendous advantage relative to using third-party shippers like UPS or the Post Office or Federal Express. And so, now I think they just need to fill out that infrastructure that they've pulled forward and monetize it. And I think it gives them a tremendous advantage in completing the e-commerce loop between the vendors on their site and the delivery within a day or 2 days. And very difficult for other companies to match that. That's why we own Amazon. That's why we like Amazon. I think in the case of Alphabet or Google, that company was hit the hardest of the FANG companies during the pandemic. They had 20% of their advertising coming from travel and hospitality and small businesses that were impacted by the crisis. And so, they recorded the first decline in revenues in their history. I think they're well positioned for a snapback in advertising in 2021 and 2022. And I think the company is focused a little bit more on shareholder returns and efficiency. So I think there's a nice change there in terms of how the company's managing itself and how they're taking care of shareholders. They're starting to buy back stock more aggressively, and we like this more shareholder-friendly approach.
And finally, in terms of headwinds, a big threat to tech is the potential increase of regulation to the technology sector, particularly in relation to the more famous technology companies. Do you view this as a big concern going forward?
Yeah, I think the tech companies have become very big, not only in terms of market cap, but in terms of absolute revenues and earnings and cash flow. And so, that's going to attract governments who want their share. And so, they're going to want to get more tax revenue from the e-commerce companies and the cloud companies. And I think you're going to, any large successful company is going to have government trying to get their share of your revenues, their share of your profits and your cash. And so taxes are going up, I think, for those companies. And regulation, they're big, powerful companies. And, I think it's important for the government to set the rules, whether it's in social media or whether it's in commerce sites of, what the rules are. And maybe they're going to modify the rules to help level out competition from smaller companies. These are great companies in the end, and they have great franchises.
Walter, thank you very much for your time today.
Thank you, Kyle.